Open-end funds are a pretty standard type of investment, which include things like mutual funds and index funds. Closed-end funds are a less common investment, but they can offer some pretty significant advantages because they are typically able to offer higher returns and higher yields than funds in the open-end category. In this video, we're going to take a look at the key differences between closed-end and open-end funds in order to determine which of these is a better investment for investors like you and me. Let's get started. So first, let's start with the characteristics of an open-end fund so we can properly compare the qualities of each type of investment. Open-end funds are named because they are always open to and accepting new investments. What this means is that mutual funds and ETFs that are in the open-end category are able to continue issuing new shares as new investors become interested in the fund. For this reason, the number of shares that an open-end fund can issue is essentially unlimited. Take VOO, for example, which is an open-end ETF from Vanguard that tracks the S&P 500 index. The roughly 520 million outstanding shares represents $160 billion of assets. But let's say demand increases and there's $2 billion of additional demand for VOO. Instead of this demand driving up the price of the fund, Vanguard simply issues additional shares and lumps those $2 billion in with the rest of the fund's assets. So with open-end funds, the pool of money that is actually being invested into stocks is variable. This can be a good thing for funds like VOO, which are designed to track the performance of a certain index, because it can minimize some of the volatility that comes from the market pressure and demand. It keeps the price more in line with the NAV, or net asset value, which is the market value of all of the assets in the fund. Now, VOO is technically an open-end fund in the way it's designed, but as an ETF, it doesn't trade like a true open-end fund. This is because most open-end funds don't actually trade on exchanges. You typically purchase open-end fund shares directly from investment firms like Vanguard or Fidelity. And this brings us to the primary downside of open-end funds. Because open-end funds traditionally don't trade on exchanges, you have to buy them and sell them directly from the investment firm. This means the investment firm must hold enough cash on hand to meet whatever demands that investors might have. Basically, if a bunch of investors decide they want to sell the shares of their open-end fund in a process that's called redeeming shares, the investment firm has to have enough cash to pay for all of those shares. In order to be prepared for that, a certain portion of the fund's assets will be kept in cash at all times. And this is the issue, because not all of the assets of an open-end fund will be invested. I couldn't find a clear answer on this, but it seems like most funds keep from 5 to 10% of their assets as cash. So this means for every dollar you're investing into an open-end fund, only 90 to 95 cents is actually being invested. This will effectively reduce the returns you see from your investments, because not every dollar is being put to use. So let's take a look at how this differs from closed-end funds. As you might have guessed by now, a closed-end fund is not open to new investments. A closed-end fund raises all of its capital for its investments through an IPO when it's created. Once this happens, there are no additional shares issued. This makes closed-end funds very different because you can't just buy them directly from the investment firm that manages the fund. You can only buy shares of closed-end funds on exchanges. Similarly, the investment firm is not responsible for buying those shares from you when you want to sell. When you want to cash in on your investments, you'll have to sell them on an exchange. Since the closed-end fund doesn't have the responsibility to buy your shares, they don't have to keep cash on hand like an open-end fund. For this reason, closed-end funds often have 100% of their assets actively invested, which means they can theoretically generate higher returns than an open-end fund that's invested in an identical portfolio. But these characteristics also have added benefits for investors who are interested in closed-end funds. First of all, since shares of closed-end funds can only be purchased on an exchange, they are entirely vulnerable to the effects of market supply and demand. This means that the market price of a closed-end fund is rarely identical to the price of the underlying assets, or NAV. Shares often trade at a premium or a discount to the NAV. I personally think this is really cool because you can theoretically buy a share of a portfolio of investments for less than it would cost you to replicate that same portfolio. And the possibility of getting the underlying investments at a discount is a big advantage of closed-end funds. The second benefit comes back to the fact that closed-end funds don't have to keep cash on hand. They never have to worry about an investor coming back to them to redeem shares, so they can be much more creative or unconventional with their investments. And ultimately, this means they'll be able to make investments that open-end funds wouldn't have access to. And this is another component that helps them generate higher returns than an open-end fund, because they simply have more options. Another interesting aspect to this is that a closed-end fund can't raise more capital to acquire new investments. An open-end fund can continue to attract new investors and use their capital to expand the portfolio. But a closed-end fund has to entirely rely on their performance to continue growing the portfolio. I think this is exciting because they have to be that much more responsible with their strategy, but it can also easily be a bad thing if the fund managers are irresponsible or unsuccessful. So let me quickly summarize the differences between closed-end funds and open-end funds, and then we'll get into some of the specifics of what to look for when making these kinds of investments. Open-end funds are always accepting new capital. Closed-end funds raise capital once during an IPO and do not gain any additional capital in the future. Open-end funds are bought and redeemed directly from investment firms. They have to keep cash available so that investors can redeem their shares at any time. With the necessity of having cash on hand, open-end funds cannot invest 100% of their assets, and this means they have slightly lower returns. Closed-end funds are bought and sold exclusively on exchanges. They have no liquidity obligations to investors, and this means that they can invest 100% of their assets and can invest them in more illiquid assets that open-end funds cannot invest in. Open-end funds are often priced at NAV, while closed-end funds can trade at a premium or a discount to the NAV. So as you can see, closed-end funds can offer higher returns and at discounted prices compared to what you can expect from an open-end fund. But this doesn't automatically make any closed-end fund a better investment than an open-end fund. So before you dive in, let's take a look at some important qualities of closed-end funds. In my opinion, there are 4 main categories that I want to look at before investing in a closed-end fund. And these 4 things are the diversification of the underlying assets, any leverage or debt that the fund is using, costs or fees associated with the investment, and the tax consequences associated with holding the investment, particularly when it comes to dividends. So with any fund or ETF investment, the first thing I want to look for is diversification. It's fairly common knowledge that diversifying your investments is the safest way to protect your portfolio from any disasters. Now, any closed-end fund will obviously be more diversified than an individual stock, but there are many closed-end funds that focus their strategies on a particular market sector, like real estate, while others focus on a specific type of underlying investment, like MLPs or municipal bonds. None of these are necessarily a red flag to begin with, but if you're going to invest in a closed-end fund, you have to make sure you understand what exactly they're investing in. Otherwise, you might find your portfolio overweight in a certain asset class or industry. Similarly, it's important to understand what a closed-end fund invests in so that you can understand where their profits come from. If they're offering a 10% yield, you'll want to make sure their investments support that yield, or else they might just be selling their assets and therefore decreasing their capital and the fund's NAV to fund distributions to investors. The next thing you want to look for is the fund's use of leverage. Since these funds can't raise any more capital from investors, one of the only ways they can get more cash is to borrow it. Closed-end funds are legally capped at a ratio of 33% leverage when it comes to debt. This means for every dollar in the fund, they can borrow no more than 33 cents. Leverage isn't necessarily a bad thing because it can be a great way for a fund to generate even more profits for investors without having to have more capital. But leverage does make a portfolio more volatile, so you might see these funds react significantly to drops in the market. Also, the interest from any borrowed money will be passed on to you through expenses and fees, so you have to be careful when you see funds that are highly leveraged. And that brings us to the costs and fees associated with closed-end funds. Like I said, you can expect any leverage in the portfolio to result in an added fee for you as an investor. This is listed as interest expense. Additionally, you'll pay management fees, which can be pretty high considering that all of these funds are actively managed. Management fees of any percentage can add up over time, so you really want these fees to be as low as possible. And this is a rule I stick to with most investments, but I'm actually a little more lenient on fees from a closed-end fund, and here's why. Fees come out of the fund's NAV, or net asset value. The closed-end funds are unique because they often trade at a discount to that net asset value. So from my perspective, if a fund has fees of 2%, but it's trading at a 10% discount, I'm still getting the underlying assets in my portfolio at an 8% discount. Of course, that also assumes the fund is only temporarily at a discount, and there are certainly some funds out there that are perpetually discounted. So that's just something to think about as you're looking into specific closed-end funds. And finally, you have to consider the tax consequences of these funds. Many closed-end funds are designed around income-producing strategies. This is great because you can get really high dividend payments. You just have to take a closer look and make sure the dividends you receive are going to be taxed to your benefit. Like I touched on earlier, there are many funds that focus on municipal bonds, which provide tax-free income. Although these investments are really only beneficial to people in really high tax brackets. And I actually made a whole video about municipal bond investing if you want to learn more about that. But for the rest of the closed-end funds out there, they're going to produce taxable income. So the dividends that you receive from these funds will either be taxed at your income tax rate or at the capital gains tax rate. Obviously, you want to make sure they're taxed at the capital gains tax rate because that is what's going to cost you the least in terms of taxes. But there's one other element here in the event that a fund isn't generating enough profit to pay you those dividends. Some funds are categorized as managed distribution funds, which means they have a target distribution rate that they try to deliver on every month or every quarter. The problem is, if the fund doesn't generate enough money, they still want to be able to provide that target distribution rate. In these cases, the fund will actually sell some of its holdings and give them to you as a return of capital. These aren't taxed immediately, which sounds good at first, but there are 2 problems with this. First, a return of capital reduces the cost basis of your shares. This means that when you sell your shares in the future, your profits on that investment will be calculated using the price you paid for the shares initially, minus all of the return of capital you received. When this happens, you'll end up being responsible for paying capital gains taxes on all of the distributions that you've previously received that were an untaxed return of capital. Simply put, you might be responsible for a larger tax bill than you anticipated when you sell your shares. So it's important to be aware that this might be happening. The second problem, which is just as concerning, is that when the fund can't afford your distributions, they're selling their assets to be able to pay you. This is not sustainable, because if this continues to happen, the fund will eventually run out of assets and money. So while the tax situation can be manageable, you really want to make sure the fund isn't relying on this return of capital to pay you, because it can be a red flag when it comes to the longevity of the fund. I hope all of this gave you a better understanding of the world of closed-end funds. I've been learning from John Bogle and telling myself for months that actively managed funds are dangerous, but I think closed-end funds are one of the few actively managed fund types that I might actually be interested in investing in. The fact that they trade at a discount so frequently and are able to produce much larger distributions than other investments makes them very attractive to me as a dividend investor. Let me know what your thoughts are on closed-end funds after watching this video, because I'd love to discuss it with you in the comments. And I know we didn't take a look at any specific closed-end funds today, but don't worry. Next week, I'm going to use everything we talked about today to find the best options when it comes to closed-end funds, with the primary goal of finding affordable, reasonably priced funds that offer capital growth and competitive dividend distributions. So if you're interested in seeing that, make sure you subscribe to the channel so you don't miss it. Best of luck with your investments, and I'll see you in the next video.